So how do you qualify for a mortgage if you've got part-time income or you're a gig driver, or maybe you're Uber, Lyft, DoorDash, or maybe you have an Etsy store? Ever since the advent of the internet, a lot of folks have second jobs right now. And quite frankly, as the economy gets tighter and tighter, sometimes we need a second job. So today we're going to talk about if you can qualify for a mortgage with your second job income. Now, these are what we're going to go over today. Let me change this a little bit. Oh, no, we don't want to see me. I'm not important. Let's make this bigger. There we go. Um, we're going to go through today, we're going to go through the 2023 part-time job guidelines. Now, we're going to talk about gig jobs. So a part-time job, a gig job is like a gig driver or an online business like an Etsy store, something that you're making money that is not 40 hours a week, punching a clock, doing this kind of thing. That's a gig job. Part-time employment is typically considered under 30 hours. Secondary employment, some people have 2 8-hour jobs a day. How do you do that? Or maybe you have an 8-hour job and a 6-hour job every single day. And then seasonal work. Sometimes you just work seasonal work. And the example I'm going to use here today is like if you're a teacher and you're working in the summer school program. So it's a special program that you get paid on separately, but you only do that for like 3 months once a year. How is the underwriter going to look at that income? Well, we're going to talk about that. So this is what we are calling an all agency comparison. So what does all agency mean? There are basically 5 ways to get a mortgage loan to buy a house right now. And it's Fannie Mae and Freddie Mac. Those are called conventional loan programs. So if you hear somebody say a conventional loan program, conventional really just means that it's not a government program. So a government program would be like FHA, VA for veterans, or USDA for rural development. So when we talk about all agency comparison, I'm going to give you the guidelines for part-time, secondary, and seasonal employment calculations, how you calculate your income on those things for each of these agencies. Fannie Mae is going to be a little bit different from Freddie Mac, a little bit different from FHA, from VA, from USDA. Now, the reason why this is important is because as a consumer, I really feel for you. You don't really stand a chance. Quite frankly, you have a question about qualifying for a mortgage. So you go on to Google, you type in a question, and guess what? You're going to get caught in the net of a call center. Chances are these companies spend billions of dollars a year to convince you that if you fill out a lead form, that is how you get your questions answered about qualifying for a mortgage. Well, unfortunately, you're probably going to get a telemarketer, some kid sitting in a call center, probably in Detroit somewhere where the biggest call centers are, and they're just looking for the easiest stuff they can possibly look at. They probably have not read the underwriting guidelines, and they don't know that Freddie Mac is different from Fannie Mae, or FHA is different from Fannie Mae or Freddie Mac. And so what ends up happening is you get an inexperienced or a lazy loan officer, and they will just give you the guidelines for one of the agencies. And they'll say, I'm sorry, you don't qualify because FHA guidelines are this. Well, they didn't look at Fannie Mae guidelines, which, to be honest, most loan officers know Fannie Mae guidelines, and they have no clue about Freddie Mac guidelines. They just kind of figure they're the same or whatever, but they're not the same. They're very subtle differences. The difference between Fannie Mae and Freddie Mac is probably 3 to 5%. Like they're 95%, 97% the same, but there are subtle differences. So today, an all agency comparison, we're going to show you how each agency is going to treat the calculation of part-time income. Now, this is a term that you may or may not hear, but almost all underwriting guidelines are guidelines. They're not black and white rules. Rarely will we find a guideline that says it absolutely has to be this. Normally, it'll say, well, these conditions need to exist. If those conditions don't exist, then it's not likely that you'll get an approval. So most mortgage approvals are done through what they call an automated underwriting system, or an AUS. And automated underwriting systems will look at the broad information that you put in there, and then the underwriter is required to make sure that all of the supporting documentation supports the findings that are in the automated approval. So there's this term called underwriter discretion, and this is where things get a little bit hairy. And the reason why I'm telling you about underwriter discretion is because the answer or the engagement that you have with a particular lender, there can be factors in that particular conversation that don't have anything to do with whether you qualify or not, but that lender may determine that they don't want to do the loan for you. So the reason I'm giving you all agency and I'm having this conversation with you is because I want you to understand that all lenders do not follow black and white rules. And in many cases, when it comes down to, can I use this document, or can I explain this gap of employment between this job and that job, a lot of that comes down to what they call underwriter discretion. And what underwriter discretion is basically the underwriter using their best judgment, looking for compensating factors. So maybe your file doesn't look great in this way, but your credit score is really high, or your debt to income ratio is really, really low. Those are compensating factors, and that will allow an underwriter to be a little bit more flexible on something else, which might be a gap of an employment, or it could be almost anything. I don't want to just make up stuff, because trust me, we'll run into those issues. And then finally, underwriter discretion also has a lot to do with employer risk tolerance. And employer risk tolerance, and actually I want to talk to you about that right now, that is also called a lender overlay. So Fannie Mae comes out with underwriting guidelines, and they say, follow these guidelines and we'll buy the mortgage from the bank so the bank can lend that money to another person like you so that they can qualify for a mortgage. That's how the mortgage industry works. So Fannie Mae has guidelines, Freddie Mac has guidelines, FHA has guidelines, VA has guidelines, USDA, they all have separate guidelines. Now, lenders are allowed to create rules that are more strict than the guidelines, and they're called overlays. The most common overlay is a credit score. A perfect example is if you see a VA lender online or on TV, they usually have a credit score overlay. A really popular one is Veterans United. Everybody's heard of Veterans United. They're kind of a call center type of lender. They do a lot of online advertising, but they only want the easiest loans. So they will not touch a VA loan that has less than a 620 credit score. You can't get a loan. Well, here's the catch. VA does not have credit score requirements. I could do a loan on a VA loan with a 580 credit score, a 560 credit score all day long. You don't need a 620 credit score. But my challenge with lender overlays is that they will not tell you. There's a lack of transparency. The lender will not tell you, well, we have overlays. We are choosing to use a more strict interpretation of the guidelines. So therefore, you don't qualify. And that's not true. You just don't qualify under their guidelines with their overlays because they want only a certain type of borrower. You're not the type of borrower that they want. So I want you to be aware of lender overlays because, again, not all lenders are going to treat the guidelines the same. What I'm going to share with you today are the guidelines directly from every single agency. Now, if you talk to a lender and a lender says, yeah, we don't do that, they're using an overlay. They're just choosing to not lend to you because they only want to work with borrowers that meet certain criteria, like maybe a higher credit score or a lower debt to income ratio, or more reserves in the bank, like you have 6 months reserves. All of this happens. It absolutely happens. In some cases, it's a good thing. Some cases, it's a bad thing. So let's start with Fannie Mae. We're going to go Fannie Mae, Freddie Mac, FHA, VA, USDA. So Fannie Mae, we're going to start by looking at part-time and secondary. So Fannie Mae is going to require a 2-year history of part-time or secondary employment, which means that you have to be able to show them, you have to be able to document that you've received two W-2s, right? You've been working there for 24 months. That's usually what they're looking for, that you've been there, and they're going to do that through a verification of employment. You can't really have any gaps that are greater than 30 days in the past 12 months. So they're going to be looking at that. So if you had your full-time job, you had your part-time job, you lost your part-time job, it took you 3 weeks to get another part-time job, that's okay. That's going to meet guidelines. It doesn't have to be no gaps of employment. Part-time jobs are specifically that. They're kind of part-time jobs. They don't always last forever. Now, 12 to 24 months can be considered if you have positive factors to offset the shorter history. So even though they're looking at a 2-year history, they might consider less. Now, if you have different employers, that's okay. If you don't have any gap, it's okay if you work at a Starbucks, then you work at a Pete's Coffee. Those things are going to be considered the same. And then if your part-time jobs are similar to your full-time job, that's even better. So if you're in the same relative kind of type of work, that's good. It doesn't have to be exactly the same type of work. It can be one customer service job to another customer service, one retail job to another retail, say, customer service job, one sales job to another sales job. Now, sales might be a little bit different. If you're selling, I don't know, let's call it food processing equipment, and you're doing that, and then tomorrow you're selling medical supplies, the underwriter might have a question about whether you have enough experience selling medical supplies so that the likelihood of continuation is there. This is another thing that I would love for you to pull out of this particular video here, is that there's a lot of moving parts here. And again, this isn't necessarily an overlay. Some of this is underwriter discretion. But there's a lot of flexibility here that the underwriter can use. And there are a lot of different situations and scenarios. So really, I think the whole point, what I would love for you to take away from a video like this is, if the loan officer is giving you an answer that you don't think sounds right, and it's not that the answer that they give you doesn't sound right, it's that their explanation sounds shady, right? Like they don't have an explanation. Like they say, I don't know, that's just what the underwriter told me. Like when you hear stuff like that, there's a good chance that there's underwriter discretion, there's overlays, and probably, quite frankly, the loan officer may just not know how to put the file together. So if the underwriter isn't doing the math right, they're not turning it into the underwriter right, the underwriter is going to be confused and they're just going to turn it down. So that was a little bit of a rant. So I apologize for that, but it's really, really relevant. It's really relevant. I say this all the time and I can't say it enough. Your options as a consumer are limited to the expertise or the effort of the loan officer that you get stuck with. So if they don't have experience working with your type of situation, they're not going to structure it properly. They're not going to explain it to the underwriter properly, and it's going to get turned down when maybe it didn't need to be. Maybe the loan officer just didn't know what they were doing. So anyhow, that's a little bit of a rabbit hole and a little bit of a rant. Let's move on. So Fannie Mae seasonal. Seasonal can be used when it's documented. So that's pay stubs. Maybe it's a contract. Clearly associated with seasonal layoffs. So seasonal layoffs may be farming or an orchard or something like that, where there's 4 seasons and you're obviously not growing fruit or vegetables during winter seasons in the Midwest. That's an example. The example that I gave earlier of summer school program. If you're a teacher and you're working at a summer school program, that's an example. And the income has to be reported on your federal tax returns. So if the income shows up on your federal tax returns and you can document it, Fannie Mae will allow you to use seasonal employment. Freddie Mac's guidelines on part-time and secondary. Now, this is very, very similar to Fannie Mae. You need to have a 2-year history. They will consider a 12 to 24-month history, may be considered if you have positive factors to offset the shorter history. And here's an example is if you had a full-time job in the same line of work, and now you have to work 2 jobs in the same line of work, but you haven't had that second job for 24 months, but you've been in the same line of work for years, an underwriter will consider that, or they may consider that. Again, underwriter discretion. And you kind of see what I'm talking about now when it says may be considered if positive factors to offset shorter history. Well, that sounds subjective to me. That sounds like an underwriter is going to make a decision. Freddie Mac's seasonal work. You want to verify that they've been at the same job for 2 years. That's different from Fannie Mae's. Fannie Mae's is you just need to show a 2-year history. You want to confirm a reasonable expectation of rehire. So that's going to be a verification of employment from the employer. And all they really have to do is they're going to check a box that says that the likelihood of continued employment is good. It's really that simple. It's not a big deal. And again, a seasonal employment is a teacher working a summer school program. You worked it last year and you're planning on working it this year. That would be an example of having a seasonal job that you haven't done 2 years, but because of the circumstances, an underwriter may consider that. You see where the flexibility is on this? Can you see where if you fill out a form online and it goes to a call center, the kid that worked delivering pizzas 6 months ago might not understand all of the nuances about mortgages and about underwriting guidelines. And that's kind of the reason why I want to do these videos and get this out here, is because I want you to understand what you're dealing with. The cards are stacked against you because everything says push button, get mortgage. The reality is that's a lie. It doesn't exist. Your information is going to end up on some kid's desk in a call center, and they're going to stumble through this stuff the best that they know. And that's the reality of this. All right. I've got to stay off these rabbit holes. I'm telling you, I've been doing this for so long, and I've helped so many people that have been told no from other inexperienced and lazy loan officers that it just drives me crazy. So bear with me as I rant a little bit. FHA's guidelines on part-time and secondary income. You need to have an uninterrupted 2-year history, which means you can't have a gap of employment. Now, again, here's an underwriter discretion. What does uninterrupted mean? Is it if you're not working for 2 weeks, is that okay? Yeah, that's probably okay. If you're not working a second job for 3 months, that's probably not okay. But you notice that this is not saying, like Fannie Mae said, you can't have any gaps greater than 30 days. And this one just says uninterrupted 2-year history. So that means you need to show that you had a part-time job for 2 years. And then we start to drill down. Is it the same part-time job? Were there any gaps? How was the income? It needs to be reasonable that the position will continue. FHA is going to average your income over 24 months, or they're going to use a documented increased pay rate and use the current rate averaged over 12 months. So if you've been working at a place for 2 years and this year you got a raise, instead of them averaging your income over 2 years when you made less the first year, they will average it. If you can document, I got this significant raise, they'll just average your income over that period that you got the significant raise. If it's been more than 12 months. So they'll just do 12 months instead of 24. That's important because sometimes when we're calculating second job income, here's a little insider trick. If I don't need the income from your second job, I'm not even going to put it on the application, right? There's no point. It doesn't make sense. I only need you to be able to qualify for the mortgage. There's no point in me introducing part-time work that we have to get paperwork from another employer. So if we're using your part-time job income, we probably need the income to qualify. If you need the income to qualify, the amount that you qualify for is probably going to determine not probably, it will determine the amount of home that you can buy, right? So the total amount, the total loan amount. And so how you calculate that income from that second job is really, really important. FHA seasonal work. Now, FHA considers seasonal work, it just defines it as not year round. It doesn't say, it doesn't really define hours, like how many hours you need to work. It just says it cannot be work that is year round work. Now, doesn't that sound a little bit like underwriter discretion? It is. Like the underwriter is going to look at it and they're going to decide, okay, that job only lasts 9 months. And so we're going to, so technically you could almost call being a teacher seasonal work. If you work 9 months and then you have 3 months off during the summertime, it's not considered that. But the income that you make in those 9 months is averaged over 12 months. Now I'm rabbit holing again and I don't need to. FHA says you need to be in the same line of work for 2 years. Which makes sense. But again, the same line of work doesn't have to be the same company. It can just be doing this relatively the same job. And what they're looking for here is stability of employment. So if you've been in the same line of work, you're starting to develop an expertise and experience in that line of work. And you could work for almost, if you lost your job at that company, you could almost go to any company that's in that line of work and get a job because you have a minimum of 2 years experience. And that's kind of what they're looking for there. Then what they're going to do is they're going to average the income over 24 months. Again, they're going to verify that it meets all the guidelines. They're going to take the income that you've earned for those 2 years, and they're going to average it over 24 months. And then that dollar amount is going to be added to your monthly income when they're calculating your debt to income ratios. FHA seasonal is they need to verify that you're likely to be rehired the next season. If your employment income, now this is important. So 2 things: verify that you're likely to be rehired the next season. This again is going to be a verification of employment. We're going to send a form to your employer and they're going to say, hey, what's the likelihood that they're going to work this season? And if the likelihood is good, that's it. We don't need any promises. We don't need any paperwork or contracts or anything like that. Now, if you're working a seasonal job, it's not uncommon to receive unemployment during the off season. Now, you can, using FHA, you can use the unemployment income from the off season, but you have to document that you've had a 2-year history, and then that unemployment income is going to be averaged over 24 months for the 2-year history, and then that dollar amount is going to be added to your income as other sources of income. Veteran VA loans. So VA loans, part-time and secondary employment income. They're going to verify that you have stable and reliable income for 2 years. VA of all of the agencies is going to be the most flexible. Underwriter discretion is probably the most used thing in VA loans. A lot of VA loans are just, does it make sense for the veteran? Are we putting the veteran in a good place? So there's a lot of flexibility here with VA. So they just want to verify that you've had stable and reliable income for 2 years. You must demonstrate that your income is consistent, that there's not a lot of huge fluctuations. Now, it can fluctuate over time, especially if first quarter last year and first quarter this year are similar, but second or third quarter are a little bit different. Like if there's a pattern there, but it's consistent, the pattern is consistent, that's fine too. We're going to need to verify the likelihood that you're going to continue. And they're going to want to make sure, and this is different from any of the other ones, they want to make sure that your part-time job or your secondary job does not conflict with the hours or the job duty requirements of your full-time job. Now, none of the other agencies care about that, but VA may ask for a letter of explanation, which is just a couple of sentences that says that this part-time job does not hurt my ability to do my full-time job, either because of the availability of hours or my job duty requirements. So you can see there's a little bit more flexibility here. Now, when it comes to seasonal guidelines, VA doesn't even mention seasonal guidelines, and this isn't unusual. VA does this on there's a couple of things that all the other agencies address that VA does not address. Seasonal is one of them. So what most lenders will do is when an agency is silent on a guideline, most lenders will either make their own guidelines, or most likely what they'll do is they'll borrow like FHA's guidelines or Fannie Mae's guidelines, and they'll just use those. So it may vary by lender. So if you're a veteran and you have some sort of seasonal employment, you're not working year long, and you talk to a loan officer and they tell you you can't use that income for whatever reason because the VA guidelines don't say you can, that doesn't mean you can't. That just means that there's underwriter discretion, underwriter overlays, and it needs to make sense for the lender, or it needs to make sense for the veteran. So VA especially, if you have any sort of unusual employment, you want to make sure that you're talking to a loan officer that has experience with VA guidelines, and that they have the ability to do manual underwriting as well, which means that a human being is allowed to determine whether or not you qualify or not. Last one, USDA. USDA, part-time and secondary, they require a 1-year history of working your primary and secondary employment concurrently. So they want to see that you've at least gone 1 year with 2 jobs. And then they're going to be okay with that. They're going to allow you to use that. The income is presumed to continue unless evidence that the income will cease. This is a little bit different with USDA. That you don't have to show the probability of continued employment. They're going to just assume that you're going to continue to work there unless something comes up that says that that you can't work there. So that's a little bit different. Seasonal is a little bit different as well. You have to have a 2-year history of seasonal work. The income is presumed to continue unless documented that it'll cease. And if you're applying during the off season, the employer has to verify that you're eligible to return to work and what date you are likely to return to work. And that's a little bit different from all of the other agencies. So That's it for this episode of how do you qualify with part-time, secondary, and seasonal income. And I just want to let you know, at Find My Way Home, we are a network of mortgage professionals that we consider ourselves guideline geeks. We love this stuff. We love solving problems. And not only do we love solving problems, we hate the fact that you can't get answers with a call center and that they're telling you no when it might not be no. It's either not now or they just made a complete mistake. They don't know the guidelines. So we are here to help you. So how can we help you? There's a lot of different ways. If you're seeing this on findmywayhome.com on the website, you can comment in the comment section below. If you're watching this on YouTube, you can leave a comment below. You can also visit findmywayhome.com. You can either find a loan officer on our directory. You can look by state to see who's licensed in your state. You can reach out to them directly, or you can ask us to connect you and introduce you to a loan officer that we've already vetted, that we know, like, and trust, that we are happy to introduce to you. Every Wednesday, we're going to start doing a live question and answer on Wednesdays. Just check the schedule, check the channel, make sure that you're subscribing to this YouTube channel so that you're getting notifications when we go live. I would love to say we're going to do it every Wednesday, and I would love to say that there's not going to be any gaps and that we're going to start this Wednesday, but I don't know. I'm just starting to launch this again. So subscribe so that you can be notified if we do that. And then we have more links in the details below. You can click the link to go to Find My Way Home or to be introduced to a loan officer that we know, like, and trust that can help you. So I hope this was helpful. This is a tough subject because there's a lot of folks that have second jobs right now. And I don't want an inexperienced or lazy loan officer prevent you from qualifying for a mortgage just because they don't understand the guidelines. So I hope this was helpful. If you have any questions, feel free to reach out and ask. We are more than happy to help. And I hope you have a great day. Thank you. Bye.